investments. He is Senior Wealth Advisor at Newman Group, Scotia McLeod. He joins us right now in studio, as you can see. Good morning and thanks for coming in.
Great to be here.
So we're about a month and a half or so into the year of 2025. It's been a good 5 or 6 weeks so far in the markets. What's your take on these North American stock markets? There seems to be lots of reasons to worry, but markets seem to be looking through that.
Well, you got to listen to the market. And it certainly makes sense that markets would be scared and skittish. You got inflation. Again today, PPI, which was not good. CPI yesterday, which was not good. Of course, you've got these tariff concerns. You've got high valuations. You've got high expectations. Yet the market keeps going higher and even fouling off today's number. Why is that? I think what the market is saying is that they're not buying Trump's bluster, really. If tariffs really went on in Canada and stayed on for a prolonged period of time, it would really be devastating for Canada, like really, really bad. But I don't think the United States is in their interest to put us in that position, number one, and I think it's going to hurt them a lot. And I think what investors really have to look at is what is America's biggest priority. It's their deficit. It's their 3-3-3 plan done by Besant, who is basically saying they want 3% GDP. They want a deficit, half of what it is now, 3% instead of 6% of GDP, and they want 3 million more barrels. How in the world are they going to get to 3% GDP? How in the and cut from 6 to 3, which are deflationary things, and do that with tariffs? They're not. Mm-hmm. They're not. And they're bigger. So their bigger challenge is to right size and get the trajectory of the debt. So I think that our policymakers have to say what they have to say to get reelected, and they have to, go to Europe and that sort of thing. But really what America probably really wants, we're trying to get into the mind of Trump, but I really think what they really want, they want the border. They do. Yeah. It's what they're saying.
They want the border firmed up.
They want the border firmed up. And they want maybe a couple things here and there, but then this too shall pass.
And do you think markets understand this? Is that one reason that stocks have moved higher?
I think that the market is probably the smartest mechanism for sniffing out the truth that we got. And so, why are the Canadian stocks holding in? Because, let me tell you, if tariffs go on and if they stay on for a long period of time, a lot of job losses are going to happen. A lot of people are going to move south. There's going to be tremendous dislocation. Maybe it would benefit the U.S. 10 years down the road, but it would take a long, long time. And Trump doesn't have the patience, and he's looking for immediate gratification, and he's looking for an upward sloping tape. So I think you got to look at really where their bigger priorities are. So I'm not saying, this with hubris, you just laugh this off, and because, you never know in this world, and markets are near their highs. So there's nothing wrong with having some attack capital and having some ammunition. Mm-hmm. And, so we've done that a little bit because we could be wrong. You can't just plan for the A case. You got to plan for the B and the C.
When the year began, a very common narrative was that a lot would be riding on earnings. Valuations were high, and earnings among S&P 500 companies would have to be pretty robust, earnings growth, to support those multiples. Have we seen that?
We have definitely seen that. Mm-hmm. The earnings have come out on the S&P about up 16% year to date, year over year, and the earnings expectations for a year from now are up 15%. These are very robust numbers. So if the earnings, what really drives markets, we can talk about Trump all we want, but earnings and interest rates. And the direction of interest rates right now in the States is shaky. They're even talking that maybe Powell might have to do a rate hike, possibly. But Powell's language was pretty modest yesterday. He basically said, look, we've come a long way. We've done a lot. We're looking at the PCE. We don't know what the PCE is going to be yet. I think Goldman's numbers out this morning suggest that it's up a little bit to about 3.3. But other than the United States, we have global synchronized easing. I think the market is okay with no more rate reductions for this year. We went from one in the fall to maybe none yesterday and maybe reinforced today. But I think earnings are carrying the day, and the U.S. economy is very robust. So these things together are fouling off all this negativity.
So with all of that in the background, what kind of equity market exposure are you advising for your clients?
Well, if you got a 70-30 portfolio, I think you want to be around 70-30. I mean, I think we were a little bit heavy, and we were maybe more like 75, 76. We've reduced that a little bit to have some attack capital. We want some cash. You know, these headlines are scary. They could get more dramatic. There could be gamemanship. They could put the tariffs on. They could keep them on for a week or two. Markets will come down if that happens. We want to have some attack capital.
That is Greg Newman. He's Senior Wealth Advisor